morning, traders. Today is June 4th, Saturday. What an interesting week. Let's go over everything. And before we get started, I want to highlight the fact that back in most of last year and pretty much all of 2020, I was highlighting this chart right here. This chart shows us that we've entered into a broad depreciation cycle phase that's going to last for at least another 6 or 7 years, till somewhere around 2028, 2029. This is when this cycle phase ends. The cycle phase in this, what we should expect in this cycle phase is a decreasing dollar eventually, a potential rotation in the stock market, which we had here. You can see in this cycle phase, this purple line is the S&P. You can see we had quite a bit of rotation, a cycle phase peak, downward move, recovery, downward move with the credit crisis, and then eventually we saw the Fed come in and stimulate the economy all the way up. And this gold is gold. This gold color line is gold. And you can see gold is way up here. It's actually down a little bit. Well, actually close to where it's at right now, but we're in 2022 right now, early 2022, which is right around this area where I'm pointing. Where the stock market is, it's gone up a little bit higher and come back down here recently. I'm going to tell you right now that what I expect is this cycle to continue to play out. I expect the stock market to move lower, potentially back down to these COVID lows. This is the COVID low right here. Somewhere down in this 2015-16 range is where I expect the markets to eventually find some support, maybe a bit lower. I expect the dollar, which is now up into the 103 area, up in this area, to roll over. The reason the dollar has been so strong is because global markets have moved into a fear and contractionary phase. The dollar is the safe haven, will continue to be the safe haven. You can see here, similar thing happened here. End of the appreciation cycle phase, the dollar rallied strongly. Oil and everything rallied strongly in this time frame, and then the US dollar collapsed as the markets collapsed, eventually finding lows down here around 72. Same type of thing is happening now. The dollar's up around 103, 104, oil's up near 120. The gold is holding up well, and gold will typically hold up well during this time frame. You can see gold was bottoming down here, was starting to hold up near the end of this cycle, and really started to appreciate here. And this is because there was no alternate safe haven asset. Now we have alternate, what are appearing to be safe haven assets, which are cryptos and other decentralized semi-currencies, I'll call them. The long and short of it is, I believe cryptos and everything will continue to collapse. I believe it's going to unwind very ugly. And the rally in gold could be incredible, because once the alternate safe havens or alternate currency classes start to collapse, everything is going to move back into regular currency and safe haven classes, which means the dollar could continue to move up to 112, 116, maybe a little higher, but the unwinding process could be very, very dangerous. Okay, so let's come back over to here. We are staying cautious. Nothing has changed week over week. I'll show you what has changed in my custom indexes. We're looking for opportunities in the markets. Technology may have set up a short-term bottom, may have some opportunity in the technology sector over the next week and a half. But generally, we're going to stay very cautious right now. Long-term, we're still bullish. Short-term, we're bearish. We have our 10% holding in stock. We have 65% cash. We have 25% metals, which is really our hedge position, and then we have our 10% in bonds, looking to load back up when bonds actually form a solid bottom. With regards to the trending, this is an old one, hold on. There we go. With regard to trending, we are short-term bearish, long-term bullish on the Nasdaq, the ES, the YM, the industrial, transportation, and the SPY. Nothing has changed week over week. It's been this way for 3 or 4 weeks. Gold, short-term bearish, long-term bullish. Silver, short-term bearish, long-term bullish. And oil is still bullish. We're going to look at the charts here in a minute. Now let's get into some of the proprietary custom indexes that we use. The FANGs index here has rolled lower. You can see that this peak level here is where we really need to get to start another bullish trend, a long-term bullish trend. We're going to probably establish another peak level somewhere over here in the next week or two, but we have this deep V bottom setting up off a 0.618 Fibonacci retracement. This puts us right into this range of 2020 July. This was the COVID low. Very possible we could see a rally back up above 1,000 here, which would be about a 10%, 11% rally back possibly up into this area for the technology index. But I'm going to warn you, it's got to be a short-term trade. Don't get married into this position. I think the unwinding is going to continue to take place. And I'm going to warn you that this looks like a potential V bottom setting up. Might prompt an 8, 10, or 11% rally up here into like 1050, 1080. But be cautious. I think that this is going to roll back over and eventually come back down to these 2015-16 levels. And really, I'm going to point out the middle of the COVID low. When we come across this low here, you can see we have a lot of support over in this area. So this really puts us down in the 600 range as the ultimate low for technology. This would be another 30% collapse from where we are right now. Next, we're going to look at the U.S. stock market index. Bounced again off the 382. I mentioned this a couple weeks ago. I've drawn some arrows this time showing you the trending that's taking place. We're still bearish. And really, if you look at this as an A, B, C move to this low, up here to a B move, down here potentially setting up an A, B, C move, which would put us down into this 900 level, that would complete an A, B, C move down to this low, and it puts us right into the support zone below this 618 level on the U.S. stock market index. So this little bounce here, be very, very cautious. We might see a little bit 3 or 4 or 5% higher from this level, but I doubt it's got any real legs going forward. Next, we have the Smart Cash Index, which is the global index. You can see this has rolled over quite excessively from the February 2021 highs. I've drawn my Fibonacci price amplitude arcs on this chart to show you what's going on. And in reality, ladies and gentlemen, we're trapped within this red range. This is the red range, price range that's set up through most of 2019 and prior to 2020. I think we're going to find some resistance in this. I wouldn't be surprised to see this move lower, and I'll show you on the Volatility Index why I think we're close to rolling into a deeper downward trend. This is showing us that globally, the markets have moved into the COVID mid area, and we could now be looking at a breakdown potentially back down to these COVID lows, which is going to essentially be an unwinding of these excesses, a continued unwinding. So if you look at this from a long-term standpoint, maybe I should draw a line across this high, coming across. This would put us somewhere over here in the 135 area. And I think that's really where we need to get down below to wash out these eventual lows, which would essentially be kind of an exhaustion bottom setting up. Okay, metals, looking stronger still. We have this current bullish trend that established right over here. And this is simply using RSI and price, which is similar to Fibonacci price theory. I still believe we're in a strongly bullish trend for metals, and I still believe this base bottom level off this price channel is going to continue to drive us much, much higher. It's just going to take weeks for this to start really accumulating. And again, there's been a kind of a disparity in the sense that metals are holding up quite well. The dollar's moving higher, so you would expect metals to move lower. But what's happened is metals is there's still a bunch of traders like me who believe metals are an incredible opportunity when you understand that cryptos really are a Ponzi scheme. And what's going to end up happening is as the cryptos unwind, you're going to find a lot of focus gets put back into metals with the fear that's driving the speculation in cryptos. So right now there's a lot of greed, there's a lot of hype in cryptos. And as long as cryptos stay above Bitcoin stays above the $29,000, $30,000 mark, you're going to see that continue to move away from the traditional hedging functions of gold and silver. When cryptos begin to collapse, when it really starts to unwind, you're going to see a lot of focus come back into metals as a hedging instrument and people are going to move aggressively into metals as the markets start to unwind and the Ponzi starts to collapse. This is why ultimately gold could be up above $7,000-8,000 an ounce, is because this whole process of cryptos and the Fed has created an asset bubble that we haven't seen in decades, and the unwinding process can be extremely dangerous. So again, metals look like a very solid opportunity here. We just need to be patient. Next, the valuations index. You can see the valuations are continuing to move quite a bit lower, trading in this sideways range. We're back in the 2019 upper area, which is really kind of the beginning of a kind of a blow-off peak, a speculative bubble that took place all the way up here. Eventually, ladies and gentlemen, we're going to move down to these lower levels. This is where the market would traditionally be valuing assets, and that means that we have another 30-35% or more to go to the downside with regards to valuations for unwinding. And that's why I think, like I said, long and short of it, we need to be very cautious right now. We're in a downward devaluation cycle that, again, confirms my analysis of the depreciation cycle. We may see the dollar continue to try to strengthen as a safe haven. We will see gold and silver continue to strengthen as a safe haven. We will see the stock market unwind and try to revalue. And we may see speculative assets like cryptos and other stocks that are trying to hold up really begin to weaken over the next couple of weeks and months. Okay, next is the commodity to gold cycle. This is really focused on lumber and commodities compared to gold. You can see that we're stalling again. We're back in the 2019 area. I believe as gold continues to rally and commodities deflate, we'll see this move down into the lower area. Understand that some sort of a collapse could move this down into 0.4, 0.5, 0.6 fairly quickly, but I think it's going to take time. We're definitely in an unwinding cycle phase. From the April, May peak up here, you can see that we're in an unwinding cycle phase, which means consumers are pulling away. Costs are actually reflecting very heavily on consumers right now. Food costs, gas costs, everything costs. And we're going to likely see a continued unwinding of excess bubble type price valuation levels. So understand that I'm not expecting any big bounce in the market. I'm expecting moderate bounces on the way down. And this is the real key here. The volatility index, my favorite chart, I tell you every week, is showing us that we're seeing some support. We're up above this 6 level. We're up above this 8 level. We're seeing some moderate support over the last couple weeks, but ultimately we're flagging out into this type of a formation. We're in a bearish trend. This had prompted a bearish trigger here, and we had confirmation of it right over here. You can see that gave us the bearish trigger, the next bar, the next week. We're in a bearish trend. This is not showing any bullish trending yet. It would likely, if we get any pop, this indicator will move back up here to 9.5 or 10.5, try to find some resistance, and then roll back over and move back lower, which is what I expect to happen over the next couple of weeks. So be prepared. We're going to be looking for a continued unwinding of assets until this entire speculative bubble after COVID has completely unwound. And remember, this bubble has really been going on for 7.5 years thanks to the Fed. COVID and all the stimulus prompted this massive bubble with this massive volatility. Now we're getting ready to move into the third phase of an excess phase bubble bursting, which is the extended devaluation period. That's going to mean many months or potentially years of devaluation and consolidation. This chart is showing us that there's really nothing driving a bullish trend. We would be looking at upward trending on the volatility index. We're now seeing downward trending flagging out. When this breaks this lower level, we're going to be entering a new phase of devaluation, and I believe it's only a couple of weeks away, maybe 3, 4, 6 weeks, maybe a little longer as it flags out here. So like July, August, September, somewhere over in this area, I think we could be looking at much lower prices, and we'll keep an eye on it as we go. Okay, and this is my long-term cycle chart. You've seen this before. This is telling us that wave 5 is complete way up here. I've revised my analysis. This is actually the end of a major wave. From this bottom, we have wave 2, wave 1, sorry, wave 2. At my count, this was many years ago. This was back 2021, near February, April. This was counting as a wave 5. I now believe this is a wave 5 of this extended trend, meaning this is from wave 1 to 2 down here. We now have A, B, C, D, E, or what would be considered from this low here, wave 1, wave 2, wave 3, wave 4, wave 5, completing this, what would be the third wave higher. We are now rotating back down to these levels, which I've been highlighting, the midpoint of the COVID rotation. That's where I believe we're going to find support, somewhere down in this area. And then we're going to begin, this would be wave 4, and begin a wave 5 higher. Okay, so let me come over to here, and we'll go ahead and discuss the global markets. Global markets are finding some support. You can see this upward trend here. The U.S. is in blue. The global markets are in red. We're finding some support. We're down near the COVID low levels here, or mid levels here on the global markets. I expect everything is going to try to move. Well, the global markets are going to move back down into this 700 level, and that would mean the U.S. markets are going to collapse potentially down to this 800, 900 level. We're in bearish trending. This is a grand unwinding. Think of it that way, an unwinding of excesses. The custom global asset index is rolling over, finding some support. This is a measurement of global asset, or global, call it valuation. This shows you that we are still up near peaks. Even though we've seen a big unwinding in the stock market with a 20-25% downward move, and a big unwinding in cryptos, we're still not unwinding the valuation or the asset bubble that has built up over the last couple of years. We're getting very close to a bearish trend here, which we haven't had since 2007 and 8, where we had this rotation. The Fed stepped in to try to save the market at this point. The Fed is trying to burst inflation. I believe we're going to see this asset bubble move down to these 2015-16 levels, which would put us closer to, in this case, the 1.1 to 1.2 area, somewhere down in this area is where I think we're going to find a bottom. So understand that we got to watch this as it continues to move, and we're going to watch to see an unwinding take place as the Fed tries to burst inflation. Okay, the gold depreciationary cycle phase. This shows us that gold is holding up quite well and starting to move higher. This again falls into the depreciation cycle phase. You can see I've highlighted it here in blue. It actually extends out a little further because the rally phase typically lasts, like you saw here, lasts well into the end of the depreciation phase. So we're looking at a very big run in gold going forward, just holding up at this level. We really need to see gold stay above the 1700, 1680 area to continue to base here and start to accumulate higher prices. Once we get above 2200, ladies and gentlemen, 2150, there's going to be a lot of focus on gold, and that'll probably be a very serious unwinding of other assets. The custom gold cycle index chart shows that the base that I've highlighted many weeks ago, this is a monthly chart, by the way, is holding up quite well. This is a basing pattern kind of setting up like we had over here and over here. Eventually, when this gets back up above 40, 45, we're going to have a pretty clear signal that gold is really off to the races again. This is the price of gold up here, and you can see it's holding up, consolidating, and we don't have any real example of this other than right over here. Possibly we had this peak in 2016, came back down, rolled over, consolidated, eventually broke, and you can see once it got from this level, 34, up above, say, 40, 45, we started to see accumulation in gold. Same kind of thing is going to happen here. So we're looking for a move up above 40, 45, and then we'll start to see some real accumulation in gold and possibly see a new upward trend taking place. U.S. real estate market, fresh data posted yesterday. We're seeing a rise in price reduction count. Again, we're seeing a rise in active listing count. Again, we're seeing higher prices right here. The blue line has moved higher, and we're seeing a higher share of overall price reductions compared to inventory. This is going to happen as inventory continues to rise, which is this active listing count, this orange line, and buyers are priced out of the market. You're going to see more and more price reductions. Right now, we're seeing this peaking formation start to happen. And you can see here at this particular area where active listings started to increase in 2001, and we started to see price reductions start to increase. You can see we actually peaked out, and it took almost 2 quarters for prices to start to really decline. So what we're looking at here is an absolute top in the market. This skyrocketing price reductions, skyrocketing inventory, and leveling off and increasing of days on market, which I expect to continue to increase. You're looking at a peak in prices. Fed's going to raise interest rates. They almost have to. And this is going to push the market probably by July, August into a severe downturn, I would expect. So be prepared. We're looking at a peak in real estate right now. The news you hear about, if you want to get in now before prices go up and the Fed goes up. The way it's looking right now, inventory is skyrocketing. People are getting desperate. Sellers are getting desperate. Once it shifts into a race to the bottom, you're going to see prices decline. You're going to see inventory go up. Foreclosures are already starting to creep back into the market, and that's going to get bigger and bigger and bigger as this continues to unwind. Okay, the Bradley Consumer Engagement Index has really shown us that we're near lows from 2015. I mean, you can almost point to this area and say, okay, well, here we go, 2013, 14. This is consumer engagement in the economy. If we see consumers really start to pull away, or the housing market break, or cryptos break, we could see this really collapse. We could see it move all the way back down to 2010, 11 levels. And this is, again, a perfect example of an excess bubble phase. Cryptos and Bitcoin started to take effect right over here. The housing market really started to take off right over in this area. Interest rates were raising a little bit in this area, which caused an unwinding. Fed is starting to raise interest rates. Consumers are pulling away. This is really only about a 35% decrease in consumer activity. I believe it's going to unwind even further down into this area, which would be, again, another 25-30% unwinding in consumer activity. Be prepared. We could be looking at 12 to 24 months of a fairly severe recession, in the sense that we could be looking at a wide economic contraction in the economy. And the Fed will have their back against the wall. They have to break inflation. In order to do that, they've got to unwind these excesses, which, believe it or not, means that we're going to probably see an unwinding of the speculative Ponzi scheme in cryptos as well. Next, we have the technology ratio index. This is a weekly chart, showing us that we're way down here near these lows, 2015-16. We could get a little bounce here, and I mentioned that earlier. We could get a nice little technology bounce, maybe 10, 11%, maybe a little higher. Be prepared that the unwinding will continue to take place. So if we get a little bounce here in a downtrend, it might be a great opportunity to try to catch some trades very short term in technology, but it will eventually come back down, reestablish lows, probably below these levels into the 2013-14 level, unwinding this technology bubble that's taking place. Now, I will highlight that technology is uniquely positioned in the sense that they will continue to be profitable. Technology companies, a lot of them, Amazon, Microsoft, Google, things of this nature, they're entrenched in what they've got right now in terms of profitability. That profitability may weaken, but long term, this is going to set up a very good opportunity once the bottom actually sets up. Technology will recover. You will see another technology boom take place maybe 2-3 years from now. It'll start to really accelerate. But in the meantime, be very cautious of trying to buy these little bounces in price. We're already seeing technology unwind excessively. We could see it continue to unwind as other bubbles continue to burst. Long and short of it, this is where we need to stay very, very cautious. Okay, and this is an old chart. And now we're into, this is an earlier chart from earlier 2022, April, showing us the global market collapse. Let me see if we've covered everything. Let's go to the TT scanner. TT scanner right now, this is the current TT scanner. We have a lot of bearish taking place in the system. We have a couple of long triggers that are left over, which is oil, gas, energy, utilities, and energy. The only thing that's long is energy, oil, and utilities, safe haven and oil-based. And then we have a number of shorts here in the internet index. We have a short here in a biotech. We have a short here in consumer communications. We have a short here in technology, consumer discretionary, and Nasdaq 100 technology sector. So understand that we are basically very defensive, and we are looking at downtrends in technology, biotech, consumer discretionary, and the Nasdaq 100. We are not, this is not the time to be overly aggressive trying to buy into a dip. You need to stay extremely cautious. Okay, I think we've covered everything here. Let's go ahead and take a look at the charts. So we're looking at the charts again. This is a chart I drew last week showing you the A, B, C wave. I'm expecting this D wave to peak out right over here. We came very close last week to the peak. We might actually have set the peak up, but I think we may have a 1 or 2 or 3% further to go to the upside, meaning suckering in a bunch of longs, trying to expect this move to move a little higher and then roll back over. And long and short of it, ladies and gentlemen, is this is the chart that I drew last week. If I were to duplicate this and drag it over, you can see how I'm looking at a move like this to be setting up with a low on the ES here somewhere around 34.25 or so. If this continues to roll in this type of a cycle pattern, a measured move, we're looking at another 19% downside move from pretty much the highs of last week. Okay, let's take a look at the Nasdaq. Same type of setup in the Nasdaq. I have a lot of information here on the Nasdaq, which is kind of hard for you to see, but we've started a new cycle phase here. We've rolled up almost to the midpoint of this cycle phase, and what we're looking at here, ladies and gentlemen, is the potential for a rollover from this cycle bottom. We've come around, come up. We're probably going to roll over and try to come back down into these lows. And that would be an essential measured move from roughly this peak to this low. Duplicate it from that peak to that low. Actually goes a little bit further down here to about 10,000. And again, this is a measured move. So if we duplicate this and try to compare this to here, you can see that this is almost the same move. From that high down to these lows, you've got 100% measured move. Then we have the same measured move here. Remember, we just copied this line and duplicated it. If we get the same type of measured move here, then we're looking at a potential, if I move it to this low or this high here, we're looking at 9,400 potential on the Nasdaq as an ultimate low. That would put us, let's go ahead and take a look here. Oops. That would put us into these COVID range here. So understand that would put us into this range as a potential bottom on the Nasdaq. Okay, so now let's take a look at the TradeTank charts and go over the S&P, which is bullish weekly, bearish daily. Let's take a look at the ES, the S&P futures, bullish weekly, bearish daily, just like I showed you on the gauges. Nasdaq is bullish weekly, bearish daily. YM is bullish weekly, bearish daily, which is why, again, bullish, we are not moving aggressively away from capital yet. As long as the weekly stays bullish, we're still in a potential upward trend, could be setting up a bottom. We have no confirmation long term. We need to pull all of our capital away from risk yet. This is why we're still essentially risk on based on my indicators. I'm warning you that we could move lower, but we're still risk on at the moment. Right now, gold is bullish weekly, bearish daily, turning into pink. We could see this change over the next week or two. Silver is bullish weekly in pink, bearish in red here on daily. Crude oil is obviously bullish. This 120 level, I will point out that this 120 level is really, really acting as resistance. And I'm going to say that I think if we see some pullback next week in oil off this 120 level, I think we could see a change in direction setting up. Now, I will also add a caveat that we could see another attempt at a blow-off peak, 130, 135, maybe establishing a new high very quickly, 1 or 2 days, and then a big blow-off like we had over here back below the 120 level. I'm thinking this 120 level is really setting up as resistance, and anything above this level is really kind of a blow-off peaking type pattern. Let's go to the transportation index. We are bullish weekly, bearish daily. We are pink. We could move into a weaker trend, and transportation would lead the markets. Understand that transportation index, if it broke down next week or anytime over the next couple of months, this is a very good indication that the economy is collapsing. Okay, so we need to be aware of that. Financial sector is bullish weekly, bearish daily. IWM, which is the Russell 2000, bullish weekly, bearish daily. You can see that everything is bullish weekly, bearish daily for the most part of major indexes. You can see this is the bonds, bearish weekly, bearish daily, which we're watching this bottom. We may jump into bonds if we start to see some support form. Let's go ahead and take a look at the real estate. Real estate is, this is the line I drew many weeks ago. Bullish weekly, bearish daily. You can see my expectations here are a deeper collapse, a rollover, and then a further collapse. I still believe this is very, very likely to happen. And then let's go ahead and take a look at SILJ, silver miners, still bouncing around this support. We are bearish weekly, bearish daily. This support is proving to be very solid. We had a deep bottom set up a couple weeks back. I think we're going to be looking at a recovery back up to fill this gap right here. Back into the $13 to $14 range, and this could set up a very big move to the upside, like I said, when the markets start to collapse. Now, I did create this chart. I want to highlight it for you, and there it is, Bitcoin. Now, Bitcoin is in a very interesting scenario. We've had the first speculative rally where Bitcoin got up to 30,000 in 2017. And this was really on the backs of it coming to life as a speculative asset class, an alternate currency, let's call it. Then we had this extended, prolonged period of consolidation, almost 2.5 years of consolidation, setting up this base around 6,000 or 7,000. Actually, I believe this is around 5,000 down here near these lows. Then we had the second speculative phase, which was after COVID, where it shot up from about 6,600 all the way up to 60,000 plus. Then we had this, I'm going to call it a phase two of a blow off top, which is we had the blow off phase, the moderate consolidation, the recovery phase, which everybody was claiming it was going to go to 100, 200,000. And now we've seen this extended downturn. I see a lot of resistance right now up in this area. These are all multiple unique price lows or highs setting up resistance. And I think we're looking at a blow off exhaustion phase that no one's really expecting, from where we're at about 29,000 down here to approximately 19,000, 20,000. And that will tie right back to this peak level here. And depending on what happens here, a little bit of a support level is likely. Then I think the actual bubble burst in cryptos is really going to take place, which will send metals skyrocketing. And we could be looking at an ultimate low back down here around 5,000 or 6,000. That would be roughly a 90% decrease in the price of Bitcoin over about a year and a half. So be very aware that the Bitcoin is teetering on a brink of a major collapse. And I think it's going to come in the form of an unwinding of the real speculative phase, kind of like what happened in tulips, what happened with Beanie Babies, and others. This is a great speculative asset, but we've seen this phase one with approximately from 20 grand down to 5 grand. We saw a 75% decrease. From up here around 68, 69,000 to see a 70 or 80% decrease would put us back down here in the 6 to 9,000 range. And that's the same type of a blow off that we had back over here. But this was done in a speculative bubble where we had a huge ramp up with easy money policy. We're ending that right now. This total unwinding of speculation is likely to take place, and we could see Bitcoin back down into the 1,300 to call it 2,500 range, way back down here, which would be a 93, 94% decrease. We're in a weakening period, ladies and gentlemen, and we're on unwinding bubbles, meaning that we're going to look at a potential real serious unwinding of excess speculative bubble cycles over the next 12 to 24 months. Okay, so we've covered quite a bit. And the reality is we may see a bounce in the U.S. markets over the next couple of days and weeks. Remember, I'm going to come back over here to the ES chart. We may see this bounce continue to try to push 2 or 3% higher, but be prepared. We're likely to come down to this ultimate period low somewhere around 3,400 on the S&P, and then that will end this wave 4 correction, potentially setting up a sideways wave 5. Now, we will see how this holds up, whether this is an ultimate peak up here, which it still could be, or whether we're going to see some sort of a real rally phase going higher. Right now, like I said, I think we're going to see this unwinding, and then this further unwinding, which will set the end of the wave 4 correction. Remember, if we take a look at this, and I were to try to draw, going to a weekly chart, if I were to try to draw this and show you exactly what's happening, we're having a wave 1 move from here to here, a wave 2 move from here to here, a wave 3 move from here to here, and now we set up our wave 4 move down to here, which eventually sets up a massive wave 5 going higher. And that's where I believe we're at, ladies and gentlemen. We're going to see a potential correction here that could represent another, from current levels here, somewhere over in this area. We could be looking at another 30% decrease before we see the bottom. And that's why we have to be cautious and protect ourselves. Eventually, the TradeTank master trend indicator, what I'm calling the rotational modeling system, will flip into bearish if my analysis is correct. We will get a bearish trigger. We will get out of all of our trades, and we will look to stay in cash throughout this move and trade hedge assets. Gold and silver will skyrocket during this time frame as speculative bubbles unwind, Ponzi schemes collapse, and I expect gold and silver to try to trade within this channel, this cycle channel, and move quite a bit higher. You can see I've predicted way up here where we could end up going, but long and short of it, the next move for gold is up above this 2100 level, up in this area, and then possibly a little bit of a correction, and then to move up above 2750. So we're looking at a 20% rally potentially in gold, followed by about a 6% correction, followed by about a 25 to 30% rally up above 2700. And I'm going to leave it at that. We have a lot to go over the next couple of weeks, lots of activity pending. Just understand that I'm giving you a very clear picture of where we're at, what we're trying to do to protect our assets, and it really boils down to whether or not we're going to see this extended correction. So understand whether we're going to see this extended move lower, creating an A, B, C type pattern, or whether this is going to be our bottom, or whether we're at the bottom right now. We already have an A, B, C pattern to this low. It could turn into a D, E pattern, which is a 5-wave correction. Then we would see possibly an A, B, C move up, then an A, B, C, possibly D, E move lower. So right now we're looking to find, the markets are looking for a bottom. I'll tell you this much. It's looking to try to end this devaluation, recessionary, inflationary cycle phase. And when I say deflation, I want you to understand this is a depreciation cycle phase. We've seen this bubble. This bubble is peaked. This is now in a depreciation cycle phase. We're trying to revalue assets to find opportunity. And it's either going to come in this area here, in my opinion, or in this area here, in my opinion. And those are going to be the two areas where we're going to start to try to look to trade opportunity in this market. We're not there yet, and we haven't gotten there yet in the global markets or in the U.S. markets. So we need to stay cautious and try to ride this out and understand, if my analysis is correct, this bottom is going to form near July, and or this bottom is going to form near November 2023. So that's where we're looking for some opportunity in the markets. Right now, risks are excessive. We need to stay hedged, and gold is our hedge. Gold is what we're looking at from a standpoint of, if the bubbles burst, if we see this rotate, you're going to see gold, as I explained to you, move up into this 2200 area, stall, move up to this 2600 area, stall, and then off to the races. So there you go, guys. There's your update this week. I'll let you know how we're going as we go. Look for my updates on Twitter and YouTube, and watch for the real estate market to really move into a peaking pattern over the next 3 to 4 months.